Hello, future certified management accountants. Today, we're unlocking the secret language of business financial reporting frameworks. Imagine building a complex Lego set without instructions. Chaos, right? A financial reporting framework is the instruction manual for a company's finances. It's a set of rules and guidelines that tells accountants how to record, measure, and present financial information. This ensures that when a company reports profit, it's done in a consistent, understandable way. Without these frameworks, comparing companies would be impossible. Imagine trying to compare Apple to Samsung if they use different rules. These frameworks create a common language, allowing investors, managers, and governments to trust and compare financial statements. Consistency, comparability, and transparency are the magic ingredients for a functioning market. As a future CMA, this isn't just trivia, it's your world. Management accountants use these numbers to make critical decisions, launch a product, expand globally, or acquire a competitor. Understanding the framework is as fundamental as a doctor knowing anatomy. You need to know the why behind the numbers, not just the what. Knowing the rules lets you play the game effectively and ethically. We're not just memorizing rules, we're learning the logic that holds the business world together. Financial statements like the income statement, balance sheet, and cash flows tell a company's story. The framework is the grammar of that story, ensuring it's clear and credible. And globally, there are two main traditions: US GAAP and IFRS. Let's meet them. In global accounting, two major players dominate US GAAP and IFRS. Think of them as the iOS and Android of financial reporting, similar jobs, different systems. US GAAP, or Generally Accepted Accounting Principles, is the US standard, required for all publicly traded American companies and set by the FASB. IFRS, or International Financial Reporting Standards, is the global traveler, used in over 140 countries, including the EU, Australia, Canada, and more, and set by the IASB in London. IFRS's global adoption makes it easier to compare companies across borders, fueling international investment. Why two systems? History and philosophy. GAAP evolved over decades, shaped by US needs and legal responses to scandals, making it detailed and comprehensive. IFRS was designed for global use, aiming for flexibility and broad applicability. For you, the CMA candidate, this isn't just academic. Many US companies operate globally and must reconcile both systems. You might analyze a European subsidiary or an Asian acquisition, so fluency in both frameworks is essential. Understanding who issues these standards and where they're used is your first step. GAAP and IFRS are the languages of global business. As a management accountant, you'll need to translate between them. This dual fluency is a key skill for your career. Let's explore their core philosophies. The main difference between GAAP and IFRS is rules versus principles. GAAP is rules-based, detailed, prescriptive, and specific. It's like a recipe with exact measurements and steps, leaving little room for interpretation. This leads to consistency and comparability, but can be rigid and complex. Sometimes companies structure transactions to follow the letter, not the spirit of the rules. IFRS is principles-based, broad guidelines that rely on professional judgment. It's like a recipe that says, bake until golden brown, trusting the accountant's expertise. This approach aims to reflect the true economic substance of transactions. The flexibility can lead to more relevant reporting, but also requires ethical judgment and can reduce comparability. The conceptual framework underpins IFRS, guiding judgment when rules aren't specific. For the CMA exam, understanding this philosophical divide explains why the two frameworks often reach different answers. Let's see how this plays out in practice. Let's see these philosophies in action with revenue recognition and asset revaluation. Historically, GAAP had a maze of industry-specific revenue rules, a classic rules-based approach. But now, both GAAP and IFRS use a unified 5-step model for revenue recognition, making them more comparable. The 5 steps: identify the contract, performance obligations, transaction price, allocate price, and recognize revenue as obligations are met. This convergence shows both systems can adapt and learn from each other. Now, asset revaluation. Under GAAP, property, plant, and equipment are recorded at historical cost and depreciated. No upward revaluation allowed. If land bought for $1 million is now worth $10 million, GAAP still reports it at $1 million. IFRS allows companies to revalue assets to fair value, so that same land could be reported at $10 million. This makes IFRS balance sheets more current, but relies on subjective estimates. The result? Major differences in reported assets and equity between U.S. and international companies. These choices impact real-world financial statements and business decisions. Understanding these differences is crucial for analysis. As a CMA, you'll need to adjust for these when comparing companies. These aren't just technicalities, they affect profits, assets, and strategy. Let's look at the conceptual framework behind these standards. Behind every set of standards is a master plan, the conceptual framework. It's not a rule book, but the foundation for all accounting standards. Both FASB, GAAP, and IASB, IFRS, have frameworks with similar goals. The main objective: provide useful financial information to investors, lenders, and creditors. Useful information must be relevant and faithfully represent reality. Enhancing qualities include comparability, verifiability, timeliness, and understandability. When no specific rule exists, accountants rely on the conceptual framework to guide decisions. For IFRS, this is especially critical due to its principles-based nature. Understanding the framework helps you reason through complex, unfamiliar situations. It's not just theory, it's your guide for ethical, flexible accounting. Mastering this blueprint is key for both the exam and your career. Let's zoom in on some key differences. Favorites on the CMA exam. Inventory. Both frameworks allow FIFO and weighted average, but only GAAP permits LIFO. LIFO can lower profits and taxes during inflation, making it popular in the US. IFRS bans LIFO, arguing it distorts reality and comparability. This means US and international companies can report very different profits and inventory values. As a CMA, you'll need to adjust for these differences in analysis. Development costs. Under GAAP, R&D is usually expensed immediately. Future benefits are too uncertain. IFRS splits costs. Research is expensed, but development costs can be capitalized as an intangible asset if certain criteria are met. This means IFRS companies may show higher assets and income in the short term. These differences reflect GAAP's caution and IFRS's focus on relevance. Understanding these rules is essential for comparing companies globally. They impact reported profits, assets, and strategic decisions. As a management accountant, you'll need to translate between these systems. These aren't just exam questions, they're real business challenges. Let's see why this matters in the real world. This knowledge isn't just for passing the CMA exam, it's vital in today's global economy. Investors and companies operate across borders, relying on both GAAP and IFRS to make decisions. Multinationals like Coca-Cola must consolidate results from subsidiaries using different frameworks. As a CMA, you could be central to this process, ensuring accurate, compliant global reporting. These standards directly impact mergers, acquisitions, and strategic decisions. Misunderstanding the differences can cost millions. Being fluent in both frameworks makes you a valuable asset to any organization. You'll provide insights, spot risks, and bridge global teams. This is more than number crunching. It's strategic business leadership. Mastering GAAP and IFRS empowers your career. So, how does this all relate to your CMA exam success? The exam expects you to understand both GAAP and IFRS, major principles, key differences, and practical impacts. You'll see multiple choice and essay questions testing your ability to apply these frameworks. Scenarios may ask you to calculate net income or assets under both systems, or compare companies using different standards. You'll also face conceptual questions about the objectives and qualities of financial reporting. Don't just memorize differences, understand the logic behind them. Connect each rule to its underlying philosophy. Practice with real examples to build confidence. Think of it as learning a language. Master the grammar, not just the vocabulary. This deeper understanding will help you tackle any framework question on exam day. We've reached the end of our journey through financial reporting frameworks. We defined frameworks as the instruction manuals that bring order and trust to business. We met the two titans, US GAAP and IFRS, and explored their rules-based versus principles-based philosophies. Real-world examples showed how these differences impact revenue, assets, inventory, and development costs. These aren't minor details, they can change profits and assets by millions. Understanding these frameworks is crucial for your CMA exam and your career. You'll analyze global companies, evaluate investments, and make strategic decisions. This knowledge makes you a more valuable, versatile business partner. You're not just learning rules, you're mastering the logic of global business. Keep these frameworks in mind, and you'll be well on your way to CMA success.